Our market monitor tonight says that the bull market is still alive and pullbacks will be short-lived. He's Hank Smith, Chief Investment Officer at Haverford Investments. So, Hank, first of all, do you think that this selling is going to continue into next week? And why should investors feel good about these pullbacks?
Well, look, pullbacks and corrections are a healthy process of a normal bull market. And they're used really, they're healthy really because they flush out excesses. And that's exactly what is happening today, Susie. Look at the NASDAQ. Look at the former high flyers in biotechs and social media. They are getting their socks knocked off them. And that is good. That's really where the only speculative excesses have been. Will this carry into next week? Perhaps, but we do think it will be short-lived because there's a ton of cash on the sidelines that has missed this bull market, and they're looking to get in.
Well, let's pin you down, Hank, on what you would buy right now. If these are stocks that you like, you can give us a sense of why you like them, and they're all brand names, sure. Starting with WW Granger.
Right. Sure. So they're a leading distributor of maintenance and repair and operating products. They have #1 share in the United States, which is only 6%. So there's plenty of room to grow through acquisitions. It's not a capital-intensive business, so they throw off a lot of free cash flow, which they've used to increase their dividend for 41 consecutive years, and they've reduced their share count by 10% over the last 5 years. So we think this is a good entry point here for long-term investors for really a 3 to 5 year hold.
Mm-hmm. Tell us about AnheuserBusch, ticker symbol BUD. You're looking at the stock. It's trading today at the same price it was on January 2nd. So why do you like this?
Well, look, just the opposite of Granger. This is a much more defensive company. They are the leading global brewing company with multiple great brands distributed both in emerging and developed economies. This is a classic steady Eddie. So if you have any worry about the economy, both domestically or globally, you're not going to worry about the earnings here of this company. In fact, people probably drink more when there's economic difficulty. And why now? Because they've announced that they are going to return 65 to 70% of their earnings going forward in terms of dividends, and that means large dividend increases over the next 3 to 5 years, and it's going to make it look a lot more attractive than the low-yielding fixed income, in our opinion.
Yeah, a long time ago, a savvy investor friend of mine said the first place you look in any stock market is how the brewers are doing. If they're doing fine, the rest of the market's going to be okay. What about a company like Union Pacific, obviously very economically sensitive, and the rails, until today at least, had been doing pretty well. Why do you like UNP?
Well, they are one of the leading rails with east to west, west to east lines, taking advantage of business with emerging markets. And speaking of emerging markets, they control the 6 lines into Mexico, and that is one of the exciting emerging economies today. So they are a great operator. They're a low-cost operator. It is more cost-effective to ship on rail than truck, so you don't have to worry as much about fuel price increases. And the valuation is reasonable.
All right, all good suggestions. Hank, do you have any disclosures to make about these 3 stocks?
Yes, our firm owns all 3, and I do personally as well.
All right, thanks so much. Hank Smith, Chief Investment Officer at Haverford Investments.